Good afternoon, ladies and gentlemen. Welcome to the Barometer Readings monthly conference call. At this time, all participants are in a listen-only mode. Following the presentation, we will conduct a question-and-answer session, at which time instructions will be provided. For operator assistance during the call, please press *0. I would now like to turn the meeting over to Mr. Nick Hamilton. Please go ahead, Mr. Hamilton.
Great. Thank you, operator. Hi, everyone. It's Nick Hamilton here, Vice President of Sales. Thanks for joining us for our monthly conference call. As always, we like to keep high degree of transparency on what our thoughts are pertaining to the markets, what market leadership looks like, because it's been an active 12 months to be sure. So on the call today, we will have David Burrows, Chief Investment Strategist and President of the firm, discussing market context. We also have Sal Malik, who is our Vice President, Portfolio Manager as well, that's going to provide some dedicated discussion points on the financial group. So as you know, we've been talking to you about some pretty considerable rotation that we've been conducting in the portfolios as it pertains to repositioning out of energy at roughly around this time last year as we saw our models turn weak. And we quickly rotated into areas of the market that would stand to benefit from the decline in energy prices and rotated to consumer groups. Most materially as of late, we feel quite constructive on the makeup of U.S. financials, which we will elaborate on. And to begin the call, maybe we'll have Sal speak to that point in terms of what we are observing as a catalyst in the financial space, and then we'll have David on the call to highlight more of the top-down comments. So with that, I'll turn it over to Sal.
Hey, thanks, Nick. Hi, guys. As you know, right now, when we look across our different portfolios, financials are the largest weight that we hold within the portfolios, and they're made up of money center banks like Bank of America, Citibank, and JP Morgan, and broker houses like Goldman Sachs and Morgan Stanley, and then insurance company like Sun Life, Manulife, and AIG. We do believe that we are in the part of the cycle for financials where return of capital is going to be increasing at a significant pace, and we see acceleration in consumer strength as compared to corporate strength. So over the past 3 or 4 years, corporate loans were growing at a fast pace. As we have seen the consumer get better, we expect consumer corporate loan growth to speed up, and that should be quite good for regional banks and money center banks in U.S. Over the past 12 months, we have seen the benefit that the U.S. consumer has achieved from lower energy prices. From all the stuff that we see, consumer has benefited by $120 billion over the past 12 months. And most of that money, instead of being spent, has been gone towards increased savings. So right now, U.S. consumer is sitting at the best position in terms of consumer health when we look at their household debt service payment as a percentage of disposable income. Right now, we're at 9.5%. We were at this level in the 1980s. So that tells you that the consumer is in very stable shape. Plus, when we look at the employment situation in U.S., the unemployment rate is below 6%, and the monthly change in non-farm payroll has steadily been above 200,000 jobs. And over the past 3 years, we have created more than 2.5 million jobs in U.S. But the interesting thing is that half of those jobs have been created for people between the age of 22 to 45. And when we look at the number of adults that are living with their parents who are between the age of 18 and 34, that's over more than 23 million people in U.S. that are doing that. So we think there is a pent-up demand for the housing market in U.S. too. And housing formation has been below the 1 million housing starts. That has historically been the case. Right now, we're anywhere between, on average, between 800 to a million. So we think there is a pent-up demand in housing that is good for the U.S. economy. The U.S. consumer is in the best shape it has been over the past 30 years. And with the unemployment rate coming down, we see loan growth on the consumer side to pick up. All these three things benefit the financials in U.S. Plus, the backdrop of higher rate helps in increasing net interest margins. So we believe that the U.S. financials are in a position to go through multiple expansion. Our models are quite positive, and I'm sure Dave will walk you through that. So we're expecting strong double-digit dividend growth, 3 to 5% share buybacks from all these names, and a multiple expansion going forward. And with this, I'll pass it to Dave.
Perfect. Thanks, Al. So, yes, folks, I thought maybe what we could do is just take a look from the top down. We always have our views as to what the markets are telling us, but we do take our cues from what is actually happening. The popular press is obsessed with what's going on in Greece and all kinds of other things to worry about. But at the end of the day, it's how does the market take all that information and behave. And so given the fact that we start sort of with a top-down view of the world and have a view that in a constructive environment, you should be seeing improving breadth or an improving percentage of stocks performing well. When we start with that, globally in equities, breadth continues to slowly expand. If you look at the most relevant markets, breadth in the U.S. market is slowly improving. About 60% of stocks are performing well, higher highs and higher lows, upward price trends. In Canada, about 52% of stocks are in long-term positive price trends. Both of those are roughly at midfield. We don't see markets tend to get late in a bull market until you get to the point where 70, 80, or 90% of stocks are performing well. That tends to be when everybody turns bullish and the news is good. It's interesting if you look at the most recent numbers out of Investors Intelligence. Just about 50% of stocks 50% of investors in the U.S. Are neutral. They're confused. They don't know whether the market's going up or going down. It's just not the way that people feel late in the bull market. So breadth at the macro level is expanding. Money is going into stocks. There have been some very clear leadership themes over the last number of months, and for those of you that have been on the call, I think it's been fairly consistent really going back to last fall. Consumer discretionary, which in this past week, the ETF for consumer discretionary hit a new high. Technology, a big part of the U.S. market, big beneficiary from the Internet of Things, big beneficiary from the trends in security and in cloud. The technology sector in the last 2 weeks hit new highs. Semiconductor index within the technology index hit a new high in the past week. Healthcare, very clear and consistent theme over the last 18 months, hit new highs again this week. The IBB, or the ETF for biotech, new high. FBT, which is the ETF for small cap biotech, hit new high. The IYH, which is the ETF for healthcare services, hit new high. So in a bull market, leadership tends to persist. As correlations fall, meaning that there are have groups and have nots, that tends to be a constructive thing. And so we've seen very clear leadership in consumer discretionary, technology, and healthcare. And I think if you've watched our holdings over the last number of months, you've seen a consistent rise in the financials weight, which of course is our largest weight. Now, early in the year, it probably hurt us a little bit not to have more by way of fixed income. It probably hurt us a little bit not to have more by way of REITs and interest rate proxies. Based on what we could see going on in the bond market, it was precarious at best. We have seen a significant shift in the interest rate picture. So while people grind back and forth about whether we're going to get an interest rate increase in the short-term administered rates, the bond market has given you a very clear message. Right? Long rates have gone from 165 in the U.S. to 245. That's a big backup in rates. Rates are going higher, and that's a great thing for financials. So we have been positioning for what we believe is coming next. We've seen very clear, steady improvement in breadth in financials. In the last month, we spent a lot of time communicating about the fact that the financials in the U.S. have been breaking out to the upside out of a one-year sideways consolidation. So technically, they've been breaking out. Sal talked about the fundamental reasons that point to something changing for the better. So we've got price behavior that's changing for the better. We've got fundamental characteristics that point to something changing for the better. And we're coming from a pretty solid base, having seen them all restructure over the last year. So the big money center banks, the regional banks, which include things like Signature Bank Corp, Key Corp, Silicon Valley Bank Corp, that are very domestically focused, look very attractive. The investment banks, Sal mentioned Morgan Stanley, Goldman Sachs, JP Morgan, they look very strong. And in the last 2 weeks, the insurance companies, the big insurance companies, the life cos, have broken out in the U.S. Now in Canada, hasn't been much to choose from in the financials. We focused on Manulife, which really is not so much a Canadian focus. It's a Canadian-based company that's focused outside of the U.S., outside of Canada, U.S. and Asia. But if you put all those together, it's a pretty big part of the market. In the S&P, it's about 19% of the market. We have slightly more than double weight across virtually all of our portfolios and financials. You compare that against, what the upside opportunity was in interest rate proxies, and while they were stable, certainly at 300-year lows in interest rates, we thought the risk-reward was not the right place to be. So as we sit today, the S&P 500 this past week hit a new low for correlations, the degree to which sectors are behaving the same one to the others, which means that there are some very clear haves and there's some very clear have-nots. The other group that we have to continue to keep an eye on is the commodity groups, and specifically energy. Our work continues to point to caution in these areas. In the Canadian market, it's a big part of the market. We continue to believe that 18 to 24 months ago, you hit a secular high for valuations in commodities. The group that held on the longest was energy. We know that was something we had to rotate away from last year. I know that there was a small bounce from March to the end of May. To us, that just simply looked like a retracement rally. It does not look like it is something that we should be participating in. We cannot find specific opportunities where the fundamental characteristics look good but are getting better. In fact, we continue to see deterioration in that group. So the portfolios, I think, are structured absolutely perfectly for this environment. In our equity-like mandates, we are virtually 100% equities. We are fully invested. Geographically, based on the sectors that stand out, consumer, technology, and healthcare, it really only makes sense to be focused in the U.S. The financials weight, again, very U.S.-based weighting. Canadian financials at the margin aren't a major problem, but they're not getting a lot better. And as a global investor who's given a choice, we think it's far more likely, and it's very clear based on the price behavior, that money is flowing its way into the U.S. and probably out of Canada. From a currency perspective, we continue to believe that U.S. dollar firms versus Canadian dollar. Their growth rate, the delta in the growth rate is better, and the likelihood of rising rates there versus rising rates here much greater in the U.S. Although in the income portfolios, we are hedging part of the currency exposure just simply to mute volatility. We think that there really are no positions in the portfolios as we sit today that are positions we would like to be off of. We had some difficulty in rotating away from some REITs earlier in the year on the interest rate proxy side. Virtually all of the positions stack up well in the current format. So in the balanced portfolio, we do have our minimum bond component. They are very rifle shot positions. They are small positions and liquid. We can exit if we needed to, but at this point they're behaving well. Long-short portfolio on the pooled portfolios, is as long as it can be. The short positions are very specifically in some of the sectors we've talked about, the high proxies and commodities. In our ETF portfolio, we are on the long side, virtually 100% long developed consumer-led economies, primarily U.S. And about 10% Japan. On the short side, again, commodity, which would be energy, and fixed income, long bonds, and investment grade. If anybody would like to ask some questions on specific positioning, we can certainly answer questions. But from a macro perspective, I think the most important thing to take away, when you look at the way this market's behaving in the face of bad news, good news is good news, and bad news is seen as good news. Market's incredibly resilient. The shallow pullbacks are being met with buying. There was a term we used to use all the time, which was summer rally. And I've heard a lot of people say we're concerned about summer getting quiet and things getting difficult. I think we are back in an environment where we're more likely to see summer rally. So given the fact that financials have just broken out to new highs, given the fact that semis have just broken out to new highs, the fact that healthcare has just broken out to new highs, pretty hard to expect much vulnerability in this market.
Great. So before we get to questions, folks, I'm just going to highlight a few things. Obviously, how we've organized today's call is really to talk about the current catalysts that we see and how it's expressed in our portfolios. Obviously, 100% of our holdings in our equity portfolios, high income, or any of the other portfolios are really geared towards improving economic data coming out of what was a fairly negatively revised Q1. And it's really about focusing on the clear and durable themes that we see. So as a follow-up to the call, what we will have is a series of financial slides that Sal spoke to that really highlight the catalysts that we see in the financial space. So whether that's commercial center banks, the regional banks, or the insurance names. Secondly, as Dave spoke to, the gearing of the income portfolio is basically 100% towards improving economic or things that are economically sensitive. So we have a very interesting visual that shows that we are virtually 100% negatively correlated to long bonds or the TLT index currently. And that would be very unique of a monthly income product in this environment. And not only is it important to highlight the things that you do own, but also the things we continue to feel we are comfortable sitting on the sidelines from. Energy, largely today, where there's a zero weight across the portfolios. Lastly, on the topic of the high income mandate and the period of transition that we've been conducting over the last 12 months, we have very important data to share where we highlight 7 previous periods where, due to repositioning and due to our uncorrelated style, where it can look as though we underperform over a period of average 8 months. There have been 7 periods like that dating back to 2002. It's important to highlight that once markets do become more directional following the transitions that we conduct, that the 1, 2, and 3 years following are always very accretive. So those are visuals that both either myself or Sarah or Kayla can pass along to you. So I felt that was important to highlight. So at this point, we'll open